Okay, so today we're staring down a mountain of financial data for the research company Gartner. And it can be pretty overwhelming. Our mission here is to slice right through all that noise and figure out what's really going on. And we're going to do it using a simplified checklist inspired by one of the greatest investors ever. Let's dive in. So let's try to put on our investor hats for a minute. We're going to keep asking ourselves this one simple question. Because when you look at all these numbers through a very specific, time-tested framework, you can turn a totally confusing spreadsheet into a really clear, compelling story. Here's how we're going to tackle this. This is our roadmap. First, we'll get a handle on the framework itself. Then we'll go step by step. Is it a good business? Is it financially stable? And maybe the most exciting part is the price rate. Then we'll pull it all together for a final verdict. Let's get to it. So, first up, what exactly do we mean by the Buffett way? Don't worry, we're not going to get lost in a 50-year-long business philosophy lecture. Instead, we've boiled it all down to a super simple but really powerful 3-step checklist that cuts right to the chase. And here they are, 3 simple ideas, but they're absolutely profound. Number 1, is this actually a great company? At its core. 2, can it handle the tough times? Can it weather a storm? And 3, is the stock market basically putting it on sale for us? This is the exact toolkit we're using to pick apart Gartner today. All right, let's jump into that first and maybe most important question. Is Gartner actually a high-quality business? What we're really looking for here is proof, hard evidence that this company makes money consistently and efficiently. And to figure that out, we're going to start with a key metric called return on equity, or ROE. Basically, this just tells us how good the company is at turning shareholder money into actual profits. It's a real powerhouse indicator of how profitable a business is. And whoa, okay, that is not a typo. Gartner's return on equity is a mind-blowing 228%. Now, just to give you some context, most great investors are thrilled to find a company that's consistently over, say, 15 or 20%. This number is it's off the charts. It's a massive flashing green light that suggests the company is an incredibly efficient profit machine. Huge checkmark right there. But hold on, let's dig in a little bit, because this is where the story gets really interesting. On the one hand, if you look at the last 5 years, their net income has grown at an awesome clip, over 22% a year. That's a great long-term picture. But if you look at the more recent, trailing 12 months, profits have actually dropped a lot, nearly 42%. So what we have is a crazy profitable business that's recently hit a major speed bump. That adds a really important twist to our story. Having a profitable company is fantastic, but that's only half the battle. It also has to be financially strong, strong enough to survive a downturn. So for our second check, let's take a look at Gartner's overall financial health. And the first place we look here is debt. And yikes, the company's current debt-to-equity ratio is over 9. That's more than double what it was on average over the last 3 years. Now look, high debt isn't automatically a death sentence. Sometimes companies use it to grow, but a jump this big, this fast, it's definitely a red flag. It tells us we need to pay very close attention to how much cash this company is actually bringing in. A pile of debt can be scary for sure, but it's manageable if, and this is a big if, the company is just gushing cash. And that brings us to the other side of this whole financial health coin. Because as the saying goes, what you really want are cash-generating machines. And on that front, Gartner looks really good. Its free cash flow yield is over 11%. Just think of this like the interest rate you'd get on a savings account. It's how much cash the business is spitting out relative to its price. An 11% yield is fantastic. It suggests the company is, in fact, a powerful cash machine. And that's exactly the kind of thing you need to see to feel better about that big pile of debt we were just looking at. All right, so let's recap. We've got a super profitable, cash-rich business, but one that's got some recent profit hiccups and a lot of debt. Now for the grand finale of our checklist. Is the market giving us a chance to buy this thing at a bargain price? And this, right here, is where things get really, really compelling. So on the left, you see the stock's current price, around $150. But then look at the right. We've got a fair value price of over $475. Now, that fair value number, it's just an estimate based on projecting future cash flows, but the exact number isn't the point. The point is the enormous gap between what the market is asking for and what the business might actually be worth. And that huge gap we were just talking about, you can boil it all down to this one incredible number, a 68% discount. This is what legendary investors call the margin of safety. It's your buffer, it's your cushion in case you're wrong about the future. And finding a margin of safety this big, I mean almost 70%, is the kind of thing value investors absolutely dream about. It suggests there's huge potential upside with a nice big safety net built right in. So, we've worked our way through the entire three-step checklist. We've looked at the quality of the business, its financial health, and the price. Now it's time to put all those pieces together and see what the final verdict looks like. And this slide really lays it all out, doesn't it? It's a tale of two companies. In the strengths column, you've got that unbelievable return on equity, a fantastic cash flow yield, and a gigantic margin of safety. But then in the concerns column, you've got that really high debt, a stock price that's gotten hammered this year, and that recent sharp drop in profits. The pros are really strong, but the cons are pretty serious. So here's the bottom line. Our little checklist investigation suggests that Gartner is a potentially high-quality, cash-generating business that the market is offering at a massive discount. But, and it's a big but, that opportunity comes with some very real, very notable red flags, especially that debt load and the recent profit slump. And that really leads us to the most important final thought. These numbers, they tell a fascinating story, for sure. But it's just as critical to ask, what story isn't this data telling us? What about the quality of Gartner's management? What are its big competitive advantages? And what's the real reason for that profit dip? The data gives us the what, but the next step for any investor is always to go find the why.